Hello, welcome back to Finance Pass, where we explore the principles of successful investing. Today, we will be talking about how the Federal Reserve, led by Paul Volcker, solved stagflation in the late 1970s and early 1980s. Paul Volcker was the chairman of the Federal Reserve from 1979 to 1987. He is best known for his drastic measures to combat stagflation, a term for an unusual economic situation where inflation rates are high, economic growth is slow, and unemployment remains steadily high. Typically, inflation and unemployment are inversely related, but stagflation presents a challenging scenario where both coexist. During the 1970s, the U.S. experienced this perfect storm of economic woes. Rising oil prices, coupled with expansive monetary policies, led to skyrocketing inflation, while economic growth stagnated. This created a dilemma for policymakers. Traditional tools to combat inflation, like reducing the money supply, could further hamper economic growth and increase unemployment. Volcker implemented a policy of monetary tightening, which involved raising interest rates to unprecedented levels. The idea was to reduce the money supply, making borrowing more expensive and curbing spending and investment. This affected the federal funds rate, which is the rate determining how much money could be loaned between banks. This is important because money is not necessarily created when the government decides to print money, but money is effectively created when banks make loans that loan money as credit to individuals, other banks, or entities like corporations. This is a process that creates new money, which eventually enters circulation in the economy and can be spent. After money has been created when banks make loans, the U.S. Mint eventually prints new currency that enters circulation. In October 1979, Volcker raised the federal funds rate, which peaked at over 20% in June 1981. This made borrowing money more expensive and reduced spending and investment. A higher federal funds rate meant that less money could be created from new loans, enter circulation, and be spent in the economy. In the 1980s, an individual could deposit money in a savings account with a very high interest rate. This encouraged individuals to save as opposed to spending due to a high return on savings. More savings meant less overall spending, which helped slow down inflation. By focusing on the interest rates, Volcker aimed to reduce the amount of money circulating in the economy. But new economic challenges appeared. Volcker's policies led to a severe recession in the early 1980s, with unemployment peaking at around 10% in 1982. However, these measures were considered necessary to bring down inflation. Volcker's actions restored credibility to the Federal Reserve, showing that it was serious about controlling inflation, which helped anchor inflation expectations. This was a policy of short-term pain for long-term gain. But how did this strategy play out in the real world? Initially, Volcker's policies were painful. The early 1980s recession was deep and unemployment surged. However, by the mid-1980s, inflation had been brought under control, and the economy began to recover. Volcker's tough measures laid the groundwork for the period of economic stability and growth that followed. Paul Volcker's tenure at the Fed demonstrated the importance of decisive action and the willingness to endure short-term hardship for long-term stability. His legacy is a testament to the idea that sound monetary policy is crucial for maintaining economic health. Hey, while you're here, do you want to beat the market? A great way to do that is to use the VIP Indicators trading tool, which is a game changer in the world of trading. With over 100,000 active members, this tool has proven its worth time and time again. Whether you are an experienced trader or brand new to trading, VIP Indicators has got you covered. To get the discount for VIP Indicators, click this link located in the description below or paste it in the URL bar. That was how Paul Volcker helped end stagflation in America. His bold actions in a time of economic crisis have had a lasting impact on monetary policy. If you found this video helpful, you can subscribe to find other videos on important economic topics and events. And let us know in the comments what other concepts you would like for us to cover. Thanks for watching.